Hey there, Investing Iguanas. Iggy here, and today we're diving into the world of REITs. Specifically, we're putting First REIT under the microscope. Is it time to buy, or should we say bye-bye? In this video, I'll break down the latest analyst reports, decipher the financial jargon, and give you the inside scoop on whether First REIT deserves a spot in your investment portfolio. By the end, you'll have a clearer picture of First REIT's prospects and be better equipped to make an informed decision. So, grab your favorite snack, settle in, and let's get started. The focus of our discussion is the recent analysis of First REIT by two prominent research groups, DBS Group Research and OCBC Investment Research. Both of these esteemed institutions have expressed a positive outlook on First REIT, endorsing it with a buy rating. This essentially means that they believe the company's stock is expected to outperform the market, making it a potentially profitable investment. However, it's important to note that while their overall sentiment towards First REIT is positive, they have made a slight adjustment to their target prices. The target price is an estimate of a stock's future price, based on an investment analyst's research. In this case, DBS Group Research and OCBC Investment Research have revised their target prices for First REIT to approximately 29 cents and 28 cents respectively. This is a slight decrease from their previous estimates. So, you might be wondering, what does this all mean? Well, the lowering of the target prices could be due to a variety of factors. It could be a reflection of changes in the market conditions, or it could be based on new information that has come to light about the company. Despite this, the buy rating indicates that both research groups still believe that First REIT is a good investment. They see potential for growth in the company, and they believe that the current stock price does not fully reflect this potential. In conclusion, while the target prices for First REIT have been slightly lowered, the positive buy rating from both DBS Group Research and OCBC Investment Research suggests that they remain optimistic about the company's future performance. Let's take a closer look at First REIT's financial performance in the first quarter of 2024. Unfortunately, the results did not live up to the market's expectations. The main factor that contributed to this underperformance was foreign exchange headwinds. To understand this, we need to delve into the concept of foreign exchange and its impact on businesses. Foreign exchange, often referred to as forex, is the process of changing one currency into another. For businesses that operate internationally, like First REIT, the fluctuation in forex rates can have a significant impact on their financial performance. First REIT, being a Singapore-based company, receives rental income from its properties located in different countries. A substantial portion of its income comes from properties in Indonesia and Japan. Therefore, the value of the Singapore dollar against the Indonesian rupiah and the Japanese yen can directly affect First REIT's earnings. When the Singapore dollar strengthens against these currencies, it means that when First REIT converts its rental income from rupiah and yen to Singapore dollars, it receives less. This situation can lead to a decrease in First REIT's rental income and net property income, which are crucial indicators of a real estate investment trust's performance. Think of it like this: imagine you're trying to buy a high-end game console from another country. If the value of your currency drops compared to the currency of the country where the console is sold, you'll end up having to spend more of your currency to buy the same console. Similarly, when the Singapore dollar strengthens against the rupiah and the yen, First REIT effectively gets less income for the same amount of rent. Indeed, it's not all doom and gloom for First REIT. While the foreign exchange headwinds have had an impact on the company's financial performance, there's a silver lining when we examine the underlying asset performance in local currency terms. In the world of real estate investment trusts, or REITs, rental income is a key indicator of health. It's the revenue that the REIT generates from its properties, and it's a direct reflection of the value that those properties are providing. In the case of First REIT, the rental income from its properties in Indonesia and Singapore has shown promising growth. Specifically, rental income from Indonesia grew by a respectable 4.5%, while rental income from Singapore saw a 2% increase. These growth rates are quite healthy, indicating that the properties in these regions are performing well and generating a steady stream of income. Meanwhile, the rental income from First REIT's properties in Japan held steady. While this might not seem as exciting as growth, stability in a volatile market can be a good thing. It shows that the properties in Japan are continuing to generate a consistent income, which can provide a solid foundation for the REIT's overall performance. So, while the stronger Singapore dollar has created some challenges for First REIT, the underlying performance of its assets tells a more positive story. The growth in rental income from Indonesia and Singapore, along with the stability in Japan, suggests that the properties themselves are performing well. This is a crucial aspect to consider because it speaks to the intrinsic value and potential of First REIT's portfolio, which is a fundamental factor for its long-term success. Let's delve deeper into the financial aspects of First REIT. The situation becomes a bit more complex when we consider the impact of higher financing costs. Financing costs refer to the interest and other costs involved in borrowing money. For a real estate investment trust like First REIT, these costs can be significant, as they often rely on borrowed funds to acquire new properties and manage their existing ones. When financing costs increase, it can put pressure on a REIT's distributable income. Distributable income is the net income available for distribution to shareholders after all expenses and reserves. It's an important measure of a REIT's performance, as it directly affects the dividends that shareholders receive. In the case of First REIT, the higher financing costs have led to a decrease in both distributable income and distribution per unit, DPU. DPU is the amount of dividends paid out per unit of the REIT, and it's a key factor that investors look at when deciding whether to invest in a REIT. However, it's crucial not to let these short-term challenges cause undue panic. Financial markets are dynamic, and it's normal for companies to face ups and downs. What's more important is the long-term growth outlook. Despite the current challenges, analysts remain optimistic about First REIT's future. They see potential for growth in the long run, which could mean that the current difficulties are temporary and that First REIT could bounce back stronger. Let's take a moment to consider the potential of Indonesia's healthcare market. It's akin to a sleeping giant that's on the verge of awakening. The healthcare sector in Indonesia is poised for significant growth, with healthcare spending per capita projected to increase dramatically. Specifically, it's expected to rise by an impressive 37% annually until the year 2028. This represents a substantial increase and indicates a burgeoning market with a wealth of opportunities. First REIT, with its strategic investments in the healthcare sector, is well positioned to capitalize on this anticipated growth. As a real estate investment trust that focuses on healthcare-related properties, First REIT stands to benefit from the increasing healthcare expenditure in Indonesia. This is because as spending increases, there will likely be a greater demand for healthcare facilities, which in turn could lead to higher rental income for First REIT. To put it in perspective, it's like being the first player in a game of Monopoly to land on the coveted Boardwalk property. In the game, Boardwalk is one of the most expensive and high-rent properties. Owning it puts the player in a prime position to collect substantial rent from opponents. Similarly, First REIT's position in the rapidly growing Indonesian healthcare market could potentially lead to significant returns. While the future prospects of First REIT seem promising, it's crucial to keep an eye on certain factors that could potentially impact its performance. One such factor is the foreign exchange rates. As we've discussed earlier, First REIT's financial performance is significantly influenced by the exchange rates between the Singapore dollar, the Indonesian rupiah, and the Japanese yen. If the Indonesian rupiah and the Japanese yen continue to weaken against the Singapore dollar, it could negatively impact First REIT's rental income when converted back to Singapore dollars. This could potentially put a damper on First REIT's financial performance. Another important factor to consider is the outstanding rentals from MPU. Outstanding rentals refer to the rent that is due but has not yet been paid. In the context of a real estate investment trust like First REIT, outstanding rentals could impact the trust's cash flow and ultimately its ability to distribute dividends to its shareholders. It's akin to playing a game of Monopoly where there's always that one player who seems to dodge paying rent. Just as that can disrupt the flow of the game, outstanding rentals can disrupt the financial stability of a REIT. Indeed, there's no need for alarm, my fellow investing iguanas. First REIT has a strategic move in mind that could potentially turn the tide in its favor. This move involves the potential divestment of one of its non-core assets, the Imperial Aryaduta Hotel and AMP Country Club. In the realm of business and investment, divestment refers to the process of selling off assets, subsidiaries, or investments to improve the financial health of the company, focus on core operations, or invest in new opportunities. Non-core assets are those that are not essential to the primary business operations or strategy of the company. In the case of First REIT, the Imperial Aryaduta Hotel and AMP Country Club falls into this category. The divestment of this asset could serve as a catalyst for First REIT's growth. Think of it as a get-out-of-jail-free card in a game of Monopoly. Just as this card can provide a player with a much-needed reprieve in the game, the divestment could free up significant capital for First REIT. This capital could then be used to fund exciting acquisitions in developed markets, which could potentially offer more stability and higher returns. These new acquisitions could diversify First REIT's portfolio and open up new avenues for revenue, thereby strengthening its financial position. It's like a player in Monopoly using the funds from selling off lesser properties to invest in more lucrative ones, thereby increasing their chances of winning the game. In conclusion, while First REIT faces certain challenges, it also has strategies in place to navigate these challenges. The potential divestment of the Imperial Aryaduta Hotel and AMP Country Club could provide the necessary capital for First REIT to make strategic acquisitions in developed markets, thereby potentially boosting its performance. As always, investors should keep a close eye on these developments and make investment decisions based on thorough research and careful consideration of their own financial situation and risk tolerance. So, what's the final takeaway from all this? Let's break it down. In the short term, First REIT may experience some turbulence. This could be due to a variety of factors, including foreign exchange fluctuations and higher financing costs. These challenges could impact First REIT's financial performance in the immediate future, leading to potential decreases in rental income, net property income, and distribution per unit. However, it's important not to lose sight of the bigger picture. The long-term prospects for First REIT are looking quite promising. One of the key factors contributing to this positive outlook is the growing demand for healthcare in Indonesia. As healthcare spending per capita in the country is expected to increase significantly in the coming years, this could lead to increased demand for healthcare facilities. As a REIT with a focus on healthcare properties, First REIT is well positioned to capitalize on this trend. In addition to this, First REIT has a savvy asset recycling strategy in place. This involves the potential divestment of non-core assets, such as the Imperial Aryaduta Hotel and AMP Country Club, which could free up capital for more strategic investments. This strategy could enable First REIT to make acquisitions in developed markets, potentially leading to higher returns and a more diversified portfolio. Drawing a parallel to a game of Monopoly, First REIT is like that player who always seems to have a knack for landing on the best properties. Despite facing challenges along the way, this player uses strategic moves to navigate the game board, always keeping an eye on the prize. Similarly, despite the short-term challenges, First REIT's strategic moves and focus on long-term growth put it in a strong position for the future. In conclusion, while there may be some bumps along the road, the future looks bright for First REIT. With a growing market in Indonesia and a strategic asset management approach, First REIT has the potential to navigate through the challenges and emerge stronger. As always, potential investors should conduct thorough research and consider their own financial situation and risk tolerance before making investment decisions. Alright, investing iguanas, let's recap. We've explored the ups and downs of First REIT, from its foreign exchange challenges to its potential for long-term growth in Indonesia's healthcare market. We've seen how analysts are cautiously optimistic, but also aware of the risks. Ultimately, the decision to invest in First REIT is yours to make. As always, do your own research, consider your risk tolerance, and never invest more than you can afford to lose. If you found this video helpful, give it a like and subscribe to the channel for more insightful investment content. Remember, investing is a journey, and I'm here to help you navigate the twists and turns. Until next time, investing iguanas, keep learning, keep growing, and keep striving towards your financial goals.